Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through the market weakness. Today, we are putting O'Reilly Automotive under some serious pressure. We're running a full structural integrity test. See, on one hand, you've got a company that looks like an absolute skyscraper. Framed in steel and built on decades of rock-solid performance. But on the other hand, the market just reacted like it found a trapdoor leading straight to the basement. So our job? Figure out if this is a buying opportunity or a warning sign. Let's get into it. So this is the number that kicked everything off. Negative 4.28%. That's how much O'Reilly's stock got hammered right after they dropped their latest earnings. Now look, a 4% dip isn't the end of the world, but for a company that's supposed to be an absolute fortress of consistency, this is a tremor. This is a real shake. It tells you the market saw something that it really did not like, something that spooked the street and had traders slamming the sell button. You gotta understand, this isn't just a number, it's a symptom, and we're here to figure out the cause. And that really gets us to the heart of the matter, doesn't it? You look at the headlines and they look amazing. You see record sales, you think, okay, great. You see record profits and you think, fantastic, even better. And then the stock just falls off a cliff. It makes no sense. It's a total disconnect. It feels like someone's telling you the building has never been stronger, but at the same time, you can literally feel the floor shaking under your feet. So what is this? Is it just the market being the market and overreacting like it always does? Or is there a real, genuine crack in this company's foundation that the big headlines just aren't telling us about? To get to the truth, we're going to run a full diagnostic here. First, we're going to dissect that shocking disconnect, the gap between the stellar results and the market's terrible reaction. Second, we are going to do the heavy lifting. We're going to inspect the O'Reilly fortress from the ground up, looking at the fundamentals that made this company a giant in the first place. Then our market skeptic here is going to put on his hard hat and go searching for the cracks. The subtle weaknesses the market thinks it found. After that, we're going to follow the smart money. We're talking insiders, big institutions. We're going to see what they're doing with their cash. And finally, we will weigh all the evidence and deliver the iron financial verdict. Okay, let's kick things off with Section 1, the shocking disconnect. This is really where the whole mystery starts. We're going to put the numbers right next to each other to see exactly what Wall Street was looking at. The devil is always in the details. And in this case, the detail was so small it was measured in pennies. But the market's reaction, that was measured in billions of dollars of lost value. And here we go. This is it. You look at the top line revenue, they actually beat expectations. They brought in $4.41 billion when the street was only looking for $4.39 billion. That's a win, no question. But then you look at the bottom line, the earnings per share. They reported 71 cents. Wall Street's consensus was 72 cents. Just let that sink in for a second. A 1 cent miss. Are you telling me that this entire negative reaction, this 4% plunge, this whole narrative shift, it all came down to a single penny? That just feels like a wild overreaction. Well, it might seem that way, but that 1 cent miss is our clue. It's our starting point. And to really understand if that's a legitimate concern or if it's just market noise, we first have to appreciate the incredible strength of the structure we're even analyzing here. So in this next section, we are going to build the O'Reilly fortress, piece by piece. We have to understand the decades of work and the steel-reinforced fundamentals that have gone into making this company an absolute behemoth. Only then can we even begin to look for any weaknesses. This, right here, this is the bedrock. This is the concrete foundation that the entire O'Reilly empire has been built on. 33 consecutive store sales growth. Just stop and think about what that actually means. It means for over 3 decades, through recessions, through market crashes, through a global pandemic, through massive shifts in how we all live and drive, O'Reilly has consistently sold more stuff year in and year out in their established stores. This isn't just some number on a slide. It's a testament to an unbelievably durable and honestly a masterfully executed business model. This is the kind of consistency that investors spend their entire careers looking for. And this foundation, it's not just some abstract idea. You can see it right here in the hard numbers. Just look at this relentless upward march. Both sales and operating income over the last 5 years have been a one-way street, straight up. Sales have climbed from $13.3 billion back in 2021 to almost $17.8 billion in 2025. That's over $4 billion in new revenue. And the operating income, that's the pure profit from the actual business, it follows that same steady climb, going from $2.8 billion up to nearly $3.5 billion. This is not a company that just had a good year. This is a company executing a long-term plan with just brutal efficiency. These right here are the load-bearing walls of the fortress. And just to really hammer this point home, look at the most recent performance. From fiscal year 2024 to 2025, their revenue jumped by over $1 billion. $1 billion. From 16.7 up to 17.8 billion. For a company of this size, adding $1 billion in revenue in a single year is a massive feat of operational strength. It proves they're not just sitting back and defending their territory, they are actively going out and capturing more market share. Okay, so if that 33-year growth streak is the foundation, then these numbers, these are the steel columns holding up the entire structure right now in 2025. Their comparable store sales growth is actually picking up speed, hitting 5.6% in the last quarter. They're expanding like crazy, adding 207 net new stores. They're giving back massive value to their shareholders, buying back $2.1 billion of their own stock. And most importantly, this business is an absolute cash machine, spitting out $2.8 billion in net cash just from its operations. This is the definition of a company firing on all cylinders. Okay, and then you've got this, a 15-for-1 stock split. But let's be honest here. A stock split doesn't actually change the value of the company, right? It's just like cutting a pizza into 15 slices instead of one. You still have the exact same amount of pizza. It feels a bit like financial engineering, doesn't it? Well, you're not wrong. It doesn't change the intrinsic value, but what it is a powerful signal. Think about it. Companies don't do this when they're nervous about the future. They do this when they're supremely confident, when they believe the stock price has a long way to run, and they want to make it look cheaper so more everyday investors can buy in. This is management sending up a flare, telegraphing a message of extreme confidence. It's like they're planting a bullish flag right on top of the fortress for everyone to see. All right, I hear you. That all sounds impressive. The fortress looks like it's made of titanium. 33 years of growth, record cash flow, bullish signals coming straight from the top. So if everything is so perfect, why did the stock drop 4%? Because every single fortress, no matter how well it's built, has a potential weak point. It's time we stop admiring the architecture and start running a real stress test. Let's go find the cracks in this shiny facade. And boom, here it is. This is the epicenter of the earthquake. The problem isn't what they did last quarter. It's all about what they said they're going to do next year. This is their guidance for fiscal year 2026. So on revenue, the high end of their forecast, $19 billion, just barely meets what Wall Street was expecting. Not great, but okay, not a disaster either. But then look at the earnings per share. They guided for $3.10 to $3.20. The street was expecting $3.32. That is a big miss. The company itself is broadcasting to the market, hey guys, don't expect us to be as profitable as you think. This right here is the primary stress fracture. So the next question is why the weaker guidance? Well, it's not because they're selling less stuff. It's a cost problem. These are the hidden pressures that are eating away at their profits from the inside out. Their SG&A expenses, that's basically the cost of keeping the lights on, came in way hotter than expected. And why? They specifically pointed to inflation in healthcare for their own employees and rising costs for casualty claims. I mean, just look at their self-insurance reserves. That's money they have to keep on hand just in case. It nearly doubled in 1 year, from $149 million to almost $300 million. That's cash that should be going to the bottom line, but instead it's just sitting there. These are like termites in the support beams, weakening the entire structure from within. And get this, while those internal costs are going up, the company's also piling on more weight from the outside. Their long-term debt jumped by $500 million in just 1 year, climbing from $5.5 billion to over $6 billion. Now look, debt isn't always bad. It can fuel growth. But when your costs are already on the rise and your profit guidance is getting weaker, adding another $500 million in liabilities, that's a reason to be concerned. It just reduces your financial flexibility. It makes you ask the question, is this fortress becoming too heavy for its own foundation? So now we have a clear conflict. On one side, you have a history of incredible, undeniable strength. On the other, you have these emerging signs of pressure. To break the tie, we need to see what the people with the most skin in the game are doing. We're talking about the insiders who actually run the company day to day and the massive hedge funds that own millions upon millions of shares. Following their money, that can give us the best read on what the true conviction is in the market. Well, this does not look good at all. The people who know this company better than anyone, the senior vice presidents, the chief financial officer, what are they doing with their stock? They're selling. And we're not talking about small amounts either. The SVP of merchandise cashed out over $9 million worth of stock. The CFO sold almost $400,000 worth. You see this consistent pattern of selling right across the executive team. Now sure,
People sell for lots of reasons. But when it's happening right before the company issues weaker guidance, you just have to ask, did they see these cracks forming before the rest of us did?
And this number right here? This is the other side of that coin. This represents the total dollar amount of open market purchases by O'Reilly insiders in the last 6 months. 0. A big fat 0. So while they were busy selling millions of dollars in shares, not a single one of them decided to put their own money on the line to buy even one share. Now remember, insiders might sell for 100 different reasons, but they usually only buy for one, because they believe the stock is going to go up. The complete lack of buying here is just a deafening silence.
But here's where it gets interesting. When we look at the big institutional money, the hedge funds, the pension funds, what we find is a split decision. In the last quarter, 766 of these big funds decreased their positions, but 733 of them actually added to their positions. It's almost a perfect 50-50 split. So what does that tell us? It tells us there is no clear consensus among the so-called smart money. The big players on Wall Street are just as divided on this as we are. Some of them are clearly buying into that long-term strength story, while others are selling because they're worried about those emerging cracks. This lack of conviction, it just adds to the uncertainty.
And just for one more layer, let's take a quick look at congressional trading. Now, the dollar amounts here are pretty small, so we don't want to make too much of it, but the pattern is what's interesting. Over the last 6 months, we've seen 4 different instances of members of Congress selling shares of O'Reilly versus only one purchase. Again, it's not a definitive signal by any means, but it does add another small weight to the bearish side of the scale. When you put it all together, heavy insider selling, a completely split institutional view, and a bearish lean from Congress, the whole smart money picture looks murky at best and pretty concerning at worst. And that brings us to the final section, the iron financial verdict. We have inspected the fortress, and we've found the cracks. We've seen the incredible historical strength, and we've seen the forward-looking weakness. So now it's time to put it all on the scales and decide, once and for all, whether this is a steel-framed opportunity or a very well-disguised trapdoor. All right, let's lay it all out, side by side. The bull case, the foundation, it's incredibly strong. You just cannot argue with 33 straight years of growth. You can't ignore record revenue, accelerating comparable sales, huge share buybacks, and a fire hose of cash from their operations. This company is a best-in-class operator, period. But the bear case, the cracks, those are real, and they seem to be growing. That disappointing 2026 guidance is a massive red flag, the rising SG&A costs, the $500 million increase in debt, and, for me, the most telling thing of all, the insiders are voting with their feet. They are selling, and not one of them is buying. That is a powerful, powerful signal that they don't think these problems are going away anytime soon. In this right here, I believe this quote is the key to the entire puzzle. It's from the CEO, Brad Beckham. He directly acknowledges the cost pressures. He says, yes, we're focused on managing them. But then he says they will always prioritize service and having parts on the shelf because that's what's critical to winning market share. He's telling you their strategy loud and clear. They are willing to take a hit on their profit margins in the short term if it means strengthening their long-term competitive position and absolutely dominating the market down the road. They're choosing to reinvest in their fortress, even if it means some of the walls look a little less profitable for a little while. This isn't a company in crisis. This is a company playing the long game. So that leaves us all with the final question. Is O'Reilly Automotive a steel-framed opportunity that's just being temporarily mispriced because of some short-term problems? Or is it a trapdoor, signaling the start of a much longer decline? The market clearly panicked and sold off on the fear of shrinking profits. But the company's strategy, which, let's not forget, is backed by a 33-year track record of success, suggests this is a deliberate choice to sacrifice some profit now for total dominance later. The cracks are real, no doubt about it, but that foundation is made of solid concrete. The final call, of course, rests with you. Our mission here at Iron Financial is just to give you the blueprint, to show you the stress points and the support beams so you can make the informed decisions you need to make to forge a stronger portfolio. Thanks for watching.